Welcome back to Sam Invests. Reaching your 50s is a critical milestone where many believe they are finally cruising toward a comfortable retirement. But the reality is that this decade is often when the most dangerous financial pitfalls can completely derail years of hard work. Whether it is over-leveraging to support adult children, ignoring crucial healthcare and long-term care planning, or misallocating a retirement portfolio in a rush to catch up, the financial decisions you make right now will dictate the quality of your later years. In today's video, we are breaking down the biggest financial traps men fall into during their 50s that nobody warns you about, and more importantly, providing you with actionable, data-driven strategies to protect your wealth, maximize your nest egg in US dollars, and ensure you remain financially secure as you approach retirement. Part 1. The aggressive portfolio catch-up trap. Reaching your 50s often brings a moment of sudden realization about the proximity of retirement, leading many men to panic and shift their investment strategy into overdrive. This reaction, commonly known as the aggressive portfolio catch-up trap, occurs when investors attempt to compensate for years of lower savings or market losses by abandoning conservative asset allocations. Driven by the fear of running out of money, they begin chasing speculative investments, penny stocks, and highly volatile assets in the hopes of achieving outsized returns. This sudden shift ignores the fundamental principles of risk management, exposing capital to severe market drawdowns, just as the portfolio should be transitioning into a capital preservation phase. The devastating reality is that a severe market correction can wipe out decades of savings, leaving very little time to recover before the planned retirement date. To move past this panic, it is crucial to understand the mathematical reality of compound interest and risk in your later 50s. Instead of trying to double your money overnight with high-risk bets, the focus should shift towards systematic savings and maximizing standard catch-up contributions permitted by tax-advantaged accounts like 401k or IRA plans. Attempting to generate an aggressive return usually requires taking on imprudent risks, whereas a well-diversified portfolio of index funds, blue-chip dividend stocks, and a portion of fixed-income assets can provide stable, reliable growth. When men make the mistake of using margin or trading derivatives to accelerate their portfolio size, they introduce the risk of severe drawdowns or complete loss of capital. The emphasis must remain on preserving the principal amount while generating sustainable income rather than trying to outsmart the market through sheer aggression. To take action and correct this trajectory, begin by auditing your current investment portfolio to determine your true exposure to speculative assets. Separate your core retirement savings from any discretionary trading accounts, ensuring that the majority of your net worth is allocated to diversified, low-cost index funds or ETFs that match your real risk tolerance. If you are behind on your retirement goals, recalculate your expected withdrawals using conservative growth estimates and look for ways to increase your annual savings rate rather than relying on an unrealistic investment return. Implement a disciplined rebalancing schedule twice a year to ensure your portfolio does not drift into dangerous concentrations of volatile stocks. By focusing on consistency and sensible asset allocation, you protect your hard-earned wealth from the unnecessary volatility of the catch-up trap. Part 2. The adult children and aging parents support trap. Reaching your 50s often places men in the difficult position of the sandwich generation, where they feel obligated to financially support both their adult children who are struggling to launch and their aging parents who require care. This trap occurs when you dip into your retirement savings to cover your children's student loans, living expenses, or to pay for your parents' medical costs without a clear financial plan. While the desire to help family members is completely understandable, the financial consequence is that your own retirement fund is being steadily depleted during the most critical savings decade of your life. Every dollar you spend on adult dependence is a dollar that misses out on crucial compounding interest, drastically reducing your financial security and increasing the likelihood that you will have to rely on your children later in life. To navigate this challenging situation without compromising your financial future, you must establish clear boundaries and alternative solutions for family financial support. Instead of providing direct cash handouts to adult children, consider offering them guidance, helping them create budgets, or allowing them to live at home for a limited period in exchange for paying a reduced rent or performing household chores. When it comes to aging parents, look into government assistance programs, local community resources, and long-term care insurance options before assuming the entire financial burden yourself. It is critical to have open and honest conversations with your family members about your own financial limitations so that they understand that protecting your retirement is the most responsible action you can take for the entire family. To take action and break free from this support trap, start by conducting a thorough review of how much you are spending on dependents outside your immediate household. Create a separate budget category for family assistance that is strictly capped and does not interfere with your monthly retirement contributions or emergency fund. If your adult children need continued support, establish a written agreement with a specific timeline for when financial independence is expected to be achieved. By separating your personal retirement security from the ongoing needs of your extended family, you ensure that you remain self-sufficient and do not become a financial burden to anyone in your golden years. Part 3. The Healthcare and Long-Term Care Negligence Trap. As men reach their 50s, the assumption of continued good health can lead to a dangerous complacency regarding future medical and long-term care expenses. This trap involves ignoring the statistical likelihood of needing specialized care as they age, relying solely on standard health insurance plans that do not cover chronic illnesses or nursing home facilities. Many individuals fail to recognize that government programs do not cover most long-term care costs, leaving them exposed to out-of-pocket expenses that can quickly exhaust their entire retirement portfolio. Neglecting this reality means that a single health event can force the liquidation of assets at depressed market prices, permanently damaging your financial independence and leaving your spouse in a vulnerable position. To address this risk, it is essential to understand the distinction between standard health insurance and long-term care coverage, as well as the limitations of government programs. Long-term care insurance acts as a financial shield against the astronomical costs of assisted living or in-home nursing care, which can easily exceed tens of thousands of dollars per year. By delaying the decision to explore these policies, premiums become prohibitively expensive, or individuals may develop health conditions that make them uninsurable. Furthermore, incorporating a health savings account into your financial strategy can provide a triple tax advantage, allowing you to build a dedicated fund specifically earmarked for future medical expenses and long-term care premiums during retirement. To take immediate action, start by assessing your family health history and the potential need for long-term care. Then research the available insurance options and their associated costs. Look into hybrid life insurance policies that offer long-term care benefits if needed, or return the premium if the coverage is never used, providing a dual layer of financial protection. Evaluate your eligibility to contribute to a health savings account through a high-deductible health plan and maximize your contributions annually to accumulate a tax-free medical reserve. By taking these proactive measures, you protect your wealth from the unpredictable costs of aging and ensure that your retirement savings remain intact. Part 4. The Lifestyle Inflation and Real Estate Trap. As men reach their peak earning years in their 50s, the temptation to upgrade their lifestyle to reflect their success becomes incredibly strong, leading straight into the lifestyle inflation and real estate trap. This occurs when individuals increase their spending on luxury vehicles, premium memberships, and larger homes that demand continuous and high-maintenance costs. Furthermore, they often hold on to oversized family homes with heavy mortgage balances and high property taxes, expecting the property value to serve as their main retirement fund. This overleverage ties up a massive portion of their net worth in an illiquid asset, making it difficult to generate the cash flow needed to cover living expenses once they stop working. The dangerous result is a home that is asset-rich but cash-poor, consuming resources that should be invested in income-producing assets. To avoid this mistake, it is essential to decouple your self-worth from your standard of living and evaluate housing needs based purely on future cash flow in US dollars. A primary residence should be viewed primarily as a place to live rather than a guaranteed investment, especially considering the ongoing costs of maintenance, insurance, and varying interest rates. Downsizing to a smaller, more manageable property before or right at retirement can free up significant equity, which can then be reinvested into dividend-paying portfolios or used to generate guaranteed income streams. Carrying a large mortgage into retirement places undue pressure on your fixed income, reducing the flexibility needed to handle unexpected expenses. The goal should be to align your living arrangements with your future retirement budget rather than your peak earning years. To take actionable steps, start by reviewing your monthly spending to identify areas where lifestyle creep has taken hold over the last decade. Calculate the total cost of your housing relative to your expected retirement income, factoring in taxes, insurance, and maintenance to see if downsizing makes financial sense for your future. If you plan to stay in your home, create a plan to have the mortgage completely paid off before you retire to eliminate that major monthly expense. By trimming the excess fat from your lifestyle and optimizing your housing situation, you free up critical capital to build a strong, liquid reserve that protects your financial independence. Part 5. The Outdated Estate Planning Trap. As men reach their 50s, they often fall into the trap of neglecting their estate planning, assuming that wills or beneficiary designations drafted decades ago are still sufficient. This oversight occurs when life events such as divorces, remarriages, new business acquisitions, or the addition of grandchildren are not reflected in legal documents, leaving assets vulnerable to unintended distribution. Failing to update an estate plan can subject your family to the lengthy and public probate process, as well as significant administrative fees and estate taxes that erode the wealth you intended to pass on. The devastating reality is that an outdated plan can spark family disputes and leave your loved ones without the clear guidance needed during an already emotional time. To avoid this trap, it is crucial to understand the tools available to protect your legacy, such as revocable living trusts and updated healthcare directives. A trust allows your assets to be distributed privately and efficiently, avoiding probate and ensuring that your family is provided for according to your exact wishes. Additionally, beneficiary designations on accounts like 401k plans and life insurance policies act independently of a will, meaning they must be reviewed regularly to ensure they align with your current family and financial situation. Taking the time to structure your estate properly ensures that your hard-earned dollars remain in the hands of your intended beneficiaries rather than being consumed by legal costs. To take action today, gather all of your current legal documents and evaluate whether they reflect your current financial reality and family structure. Schedule a meeting with a qualified estate planning attorney to draft or update critical components like your will, trust, power of attorney, and healthcare proxy. Make it a habit to review your beneficiary designations every few years to ensure they remain accurate. By taking these steps, you build an impenetrable shield around your legacy, providing peace of mind and financial security for the generations that follow. Navigating your 50s doesn't have to be a financial minefield if you take the right steps today to secure your wealth and protect your future. By avoiding the aggressive catch-up trap, setting firm boundaries with dependents, preparing for future healthcare needs, trimming lifestyle inflation, and updating your estate plan, you are taking control of your financial destiny and ensuring a legacy of financial independence. If you found this information valuable and want to continue building your wealth with practical, actionable strategies, please subscribe to the channel so you never miss an update on your journey to financial freedom. I would love to hear your thoughts and engage with you. So please leave a comment below with a phrase or key takeaway that resonated with you the most from today's video. Thank you for watching, and I will see you in the next video.